Hello, and thank you for tuning in to today's webinar on maximizing PPP loan forgiveness. My name is Jamie Terrell, and I lead marketing and communications here at Saltmarsh. I will be your moderator for today. If you're new to our webinars, welcome. You can find all of our previous presentations, including PPP parts 1 through 9, on our Saltmarsh COVID Hub and YouTube channel, which you see here on your screen. Back again for part 10 in our series are 3 members of our COVID recovery and response team, Suzanne Cox and Andrew Kent, both shareholders here at Saltmarsh. They're of course joined by Norm Provvidenza, director in our firm's tax practice. As always, we'd like to thank each of you for being here with us and of course following the developments and bringing us the latest once again. So before we get started, just a few housekeeping notes I'd like to mention. First, everyone on the line has been muted. If you do have questions, you're welcome to share them with me. You have a Q&A feature in your GoToWebinar controls. You can go ahead and type that question to me. I'll hold those. If we have time to address them at the end, we will. And if not, know that someone from our team will reach out to you directly after today's presentation. You can also email your questions to us at ppp@saltmarshcpa.com. You see that on your screen as well. Someone will be happy to reach out and respond to you that way as well. Today's webinar is being recorded and you'll receive it by email tomorrow with us. You'll receive it from us tomorrow along with a copy of your slide deck. You think that this is my first time doing this, right? You wouldn't even realize that we've been doing this since.
It's part 10, man. You should have all this memorized.
That's right. Okay, so you're going to get these materials from us. After today's presentation, you'll get the slides and a copy of our recording. And of course, upon leaving, you'll be prompted to take a really short survey. If you'll take just a couple of minutes, tell us what you thought. If there are other topics you'd like us to touch on as part of our web series, we'd be happy to consider that. So please take a moment, tell us your thoughts as you leave. And with that, I'm going to hand this over to Andrew Kent to get us started today. Andrew, over to you.
Excellent. Thank you, Jamie, for that great introduction, and welcome everybody this afternoon to join us for part 10. It has been a year almost of PPP webinars with the Saltmarsh team. So today's agenda, we're going to try to cover a lot of material. I'm going to maybe branch out a little bit from PPP because there's a lot of things that are really new that interact with PPP loans. So we're going to talk a little bit about the American Rescue Plan Act. We're going to talk about how that interfaces with the changes that it brought to the PPP program, and then how some of the new aspects of that act interact with the PPP loan program. We're going to talk about some changes to the PPP loan program itself. We're going to talk about employee retention credits. This is a huge issue, been a topic. Had a lot of conversations with clients recently about the employee retention credits. It's been at the forefront of everybody's minds. So we're going to spend a few minutes talking about that, and then an update on the forgiveness process that we're seeing with our clients. So Suzanne, you want to advance to the next slide and we'll jump into it. So the American Rescue Plan Act, or we're going to abbreviate it ARPA here because we love our acronyms for accountants. It was signed a couple weeks ago on March 11th. $10,200 exclusion of unemployment benefits, extension of $300 increase in weekly unemployment benefits. So these are kind of the stimulus features that you've heard of out there. COBRA subsidy. So COBRA is, your health insurance if you are laid off or let go. So COBRA insurance subsidies, changes to child tax credits, including advances on child tax credits for qualifying households, changes to the dependent care credit in EIC. It extends the ERC through 12/31/21 and extends and modifies sick and family leave credits through 9/30/2021. So this is just a few of the aspects of the ARPA. There's others, including the direct stimulus payments that people are receiving, but these are some of the ones that may interact with you as employers or interact with your PPP loan. Norm or Suzanne, anything I'm missing or we want to bring up on ARPA?
Yeah, I think Norm's got a few notes here for sure we want to talk about.
Yeah, I think what's glad you mentioned this, Andrew. Here, I think the COBRA subsidy is interesting because it's going to apply so eligible individuals starting April 1st, 2021, and going through September 30th, 2021. If employees are on let's say they need insurance and the employer covers and pays 100% of that cost for COBRA, they're going to actually be able to take a credit, a tax credit, and it's done via the payroll tax returns, ladies and gentlemen. Again, we're seeing the payroll tax returns in play here in claiming that credit. And then obviously if it's over and above the payroll taxes reported on the payroll tax return, you get a refund. So that's an interesting piece to this COBRA subsidy I thought I would mention. You know, the child tax credit, generally speaking here, went from $2,000 to $3,000. It's now fully refundable for 2021. Looks like right now it's only refundable for 2021. We'll see if there's any changes to that. And, you know, the dependent care credit has gone up. You know, so it was originally a maximum of $4,000. I'm sorry, the maximum now is $4,000 for single individuals, and then married filing joint, and you can get up to $8,000 if you have 2 or more qualifying individuals or child. So again, and they're refundable. Before that credit was not refundable. Now the dependent care credit is refundable for 2021. So a few interesting things there that I thought I'd mention. Thanks.
Excellent.
Hey, Norm, I think there was something we want to talk about as far as if you've already filed a tax return and you have an unemployment exclusion. There was something about if you've already filed, they'll go ahead and you don't have to refile. They're going to send you your refund, right?
Right. Yeah. So what thank you, Suzanne. That's a good point. With this unemployment benefits exclusion, the 10,200, you know, folks are asking, what if I already filed and, you know, I paid tax on the full amount of my unemployment? Well, what the IRS has just come out and announced is that they don't want you to amend the return. They don't want you to go do that. They're inundated enough, so it probably makes sense why they don't want you to do that. But instead, they're saying that they're going to be able to figure out what, you know, that exclusion and send you the money directly. You know, don't hold our breath, everyone, but we'll see what happens here. I mean, amazingly, they're going to have the technology to do this. I'll believe it when I see it, but that's what they're saying.
Yeah, there's a lot of these things we're going to talk about today where they just supposedly have a list and they're going to just send us all money. So like Norm said, we're not holding our breath, but that's what we understand is happening from a procedural standpoint. So yeah, that's interesting. But yeah, moving on. I don't have anything else to add here to this one.
No, I mean, Norm, to your point about, you know, being backlogged, it's my understanding that the IRS is still processing returns from last year. I mean, they're substantially behind because of the extended deadlines and everything else that's happened. So so let's focus in a little bit more on the ARPA expansion of PPP loan eligibility. So once again, in ARPA, there were a number of new programs or aspects of the law that impacted PPP, the PPP loan program. One of which, several of which actually focus around eligibility. And we've actually had some clients that are impacted by some of these. So ARPA clarified the eligibility for restaurants and other hospitality businesses. That it's, and these are companies that begin with the North American Industrial Classification System, our NAICS codes, beginning with 72. They're typically hotels and restaurants. That it's the employee limit, the 500 person or 500 employee limit is 500 employees per physical location. So that's a key exception. It's not just per organization, it's per physical location. The ARPA also expanded eligibility and relaxed the affiliation rules for certain nonprofits. And this is something that's impacted a number of our clients. So 501c6 organizations, such as chambers of commerce or destination marketing organizations, they are now exempted to no more than 300 people per physical location. 501c3s, which are just your ordinary not-for-profits, not more than 500 employees per physical location. So this is a distinct break. We have a number of clients, for example, in the healthcare space that may have multiple facilities. They operate as a not-for-profit. On the aggregate, they had affiliation problems, but now this is clarifying that they're not going to be each individual location, as long as it has less than 500 employees, won't meet the affiliation limits. And then other 501c organizations that have no more than 300 employees per physical location. So if you're a not-for-profit, If you operate under any one of these 501c sections of the code, and you have questions, or you did not apply for a loan because of the affiliation rules, well, now you may have the ability to step back into the program and apply for a first draw PPP loan, because a lot of these were exceptions. You know, we have a lot of clients who did not take out a first draw loan because they did not pass the affiliation test. And then there's additional exemptions for certain internet news or internet only periodical publishers that employ, once again, not less than 500 people per physical location. So
we don't know exactly what internet only news place would have 500 physical people, but for those that do, you know,
yes,
they
exactly. All right, excellent. PPP loans and the Shuttered venue grant. So once again, more modifications to eligibility for PPP loans. So there is a new, in ARPA, there's a new Shuttered venue operator grant program. And so this is a great, a great opportunity for venues that might qualify under this grant program. And there's a long list of kind of qualifications, but it's, it's basically public venues that house, theatrical or music type events. That program makes up to $10 million per operator to replace revenues up to 45% of gross earned revenue. So it's a revenue replacement grant. It's a really potentially very impactful program for these venues. The program is still kind of in the works and has not been actually opened yet, but importantly, it interacts with PPP. So if you think you might qualify for one of these Shuttered venue operator grants, if you had a loan that was funded prior to December 27th of 2020, you can apply for the grant in 2021. If you have applied for either a first or second draw loan that was funded or will be funded after December 27th, 2020, you can still apply for the Shuttered venue operator grant. You're not precluded from it, but your grant will be reduced by the amount of any PPP loan that gets funded during that period. So, Norm, Suzanne, anything to add there?
Just maybe one note on what is a shuttered venue. For the simplistic definition, it's if you pay performers to perform at your venue. That's one of the more key items there. So just if you're curious, this is going to help places like the performing arts centers and the Straws here locally in Tampa. So that's who will be getting these. Sports venues are not included. So again, just clarification for those of us that are curious, because a sports venue doesn't pay the sports people to come play games there. They are paid through their league or whomever. So this is where the actual venue pays performers.
Yeah, those are great points.
Or for curiosity's sake,
Eligible payroll costs updates in ARPA. So once again, more things inside ARPA that impact the payroll protection loans, including the clarification that certain payroll costs are no longer going to be eligible for PPP loan forgiveness. And so some of this is some things that we've already kind of known through other guidance, but ARPA clarified it. So for example, you can't double dip. So Norm's going to talk to us about the employee retention credits in just a few minutes, but if you use wages to calculate your employee retention credits, you can't use those same wages to calculate your PPP loan forgiveness. So, once again, you can't double dip. Wages used to support disaster credits. So we have some clients that are in hurricane disaster zones for 2020 that may have disaster related credits, and you can't use wages if you applied and received those disaster credits. Once again, people are probably looking at their 940s and 941s more than they ever have in their business history, because you've got all these credits this year that depend on those payroll tax returns, or that revolve around those payroll tax returns. But if you use wages to obtain disaster credits, or we were talking about COBRA earlier, you have, as the employer, have paid premiums for COBRA continuation coverage and have received a tax credit. Once again, on your 940. you can't use those premiums that you paid to support for as there. None of those things can be used as payroll to obtain PPP loan forgiveness. So
yeah, conceptually, it goes back to that double dipping standard. You know, if you're using it to get a different kind of credit, you can't use it for that kind of credit. So you can't use the same payroll for two different kinds of credits. General rule of thumb is think about it as the double dipping concept.
Yep. No, great point. So, and I think with that, we are going to dive a little deeper into the employee retention credits and hand it over to Norm. Norm? We
got a lot of comments after the last webinar on how ERC was so hot. So we gave Norm the whole rest of the slideshow. So Andrew and I are just going to take off now. Y'all have fun.
It is hot. It definitely is hot, Suzanne, and rightly so, because folks, this is could be a very substantial credit for businesses, and I think businesses are starting to catch on to this, and they're saying, hey, we better look at this. And so that being said, let's just kind of dive in a little bit. This first slide here just gives us a little bit of the background on the ERC itself. You know, at one point, you may all recall, we talked about this last time, you couldn't obtain the ERC if you were a PPP borrower in 2020. Well, they relaxed those rules and gave that opportunity now for those businesses that got a PPP loan in 2020. You could actually go back and claim the ERC as well. So that was some good news there. It's been extended. You know, before it was through June 30th, right? June 30th, 2021. Now it's been extended throughout the rest of this year. So 12/31/2021. So that's a welcome benefit. You know, we talked about this before. It's a refundable credit, and it's claimed on the payroll tax returns. You can try to get a file form 7200 and obtain a refund, you know, in advance of the credit, and then reconcile it on your payroll tax return. So that's certainly an option. My comment there is that gets mailed in, right? So God only knows when we're going to get, you know, the IRS will process that. So I think a lot of folks, we're not seeing a lot of that with that 7200 form. The 2020 credit, it's different between 2020 and 2021. So to calculate the credit, it's 50% of the qualified wages for 2020. It's capped out at $10,000 per employee, and notice it's highlighted there per year. But in 2021, it's now 70% of the qualified wages up to the $10,000 cap, but it's per employee per quarter. So it enhances that ERC even more, makes it much more, a bigger appetite, I think, for a lot of our clients. So, and then we, of course, have, you know, the qualified wages do, in fact, include health benefits and pre-tax 401k contributions. So those are a few things there that we have there. You know, employer matches, we've had this question, employer matches of the 401k are not qualified wages. And if you laid off employees and you continued to pay their health benefits, those health benefits would count as qualified wages. So you'd be able to use that to claim the ERC. So those are a few things there. Any comments from Andrew and Suzanne on that slide?
Nope, I think you covered it.
So who's eligible? Let's talk about the eligibility here. You have to meet at least one of the following there you see on the slide. You know, operations were fully or partially suspended due to COVID-19 and had to be related to a governmental order. You know, you may recall last time we were all wondering, well, what does that mean? And we need more guidance. And I'll just kind of steal a little thunder from myself right now to tell you that that guidance has now been issued. IRS, or it's Internal Revenue Code, I'm sorry, IRS Notice 2021-20 that was issued. And that was just recent. It was about a week ago and maybe a week and a half ago. And that is a great tool. I encourage you all to, you can simply Google that, and you're going to see we have some more on that in the presentation here. But it's easy to read. It has several examples, very helpful examples on exactly what do they mean by partially shut down due to COVID and a governmental order. So I will tell you, you're going to want to look closer at that. That'll help you out a lot. Of course, the easy, more easy answer to get to with ERC is looking at gross receipts, right? numbers don't lie. So you look at, okay, the decline in gross receipts had to be greater than 50% during a 2020 calendar quarter compared to that same calendar quarter in 2019. Again, either one of those you met, you didn't have to meet both. You would be able to get the ERC and take advantage of that. Now for 2021, they made some changes. The decline now has to be greater than only 20%. So they relaxed it a little bit, and it's for during any 2021 calendar quarter, still comparing it to the same calendar quarter in 2019. Some folks are making the mistake of comparing it to a calendar quarter in 2020. No, you're still going back to comparing it to 2019. And there is, you'll see there I have in red a safe harbor. And so here's how this works. We're sitting in 2021 right now. And most of us may, our clients may not know whether or not they've met the test for 2021 when they do that test for the decline in gross receipts. So what you can do is you can look, for example, at your Q4 2020 gross receipts, and you get to compare that to Q4 2019. And if you met that 20% or greater decrease, you will qualify for the ERC for Q1 2021. So that's an important feature there because some of us may not have that answer yet. Of course, we talked about this already. You can't use the wages for both the ERC and the PPP loan forgiveness process. That's all I have on that slide. I don't know if anybody has anything else. Okay, so here's some exciting stuff. All right, so here's some new stuff, expansion under ARPA. Okay, so what do we got? We talked about how it's going to go through the end of this year, 2021. But there's a couple of neat new features here with the ERC. So a new business. So these next two bullet points, they tried to hit on businesses that, can you imagine if you started on February 16th of 2020 and then all of a sudden COVID hit, right? That's a tough deal. Well, in the past, they weren't eligible. They had to be in business in 2019 to get the ERC to begin with. So this new expansion allows those businesses that might have just started in 2020 there, right after 2/15/2020, well, they're going to be eligible for the ERC, but they have a maximum credit only of $50,000 per quarter available. And look at this, they don't even have to meet the decline in gross receipts or have a partial shutdown or suspension of the business. So that's a very welcome change and expansion for the ERC for those that kind of started probably their business at the wrong time, right? It's unfortunate. So they suffered too. And the government acknowledged that and said, hey, we're going to help you. Now, the second bullet point here is really designed. So the first one was designed for those small businesses just started, right? Well, the second one's designed to handle the really large businesses that maybe, they might need some help too. They want to acknowledge them, but that one doesn't begin until Q3 of 2021. And here's the deal on that one. You have to be a severely financially distressed employer. And if you meet that requirement, you're going to be, and guess what? What is that? What is the definition of that, right? So here's what it is. It's if your gross receipts are at less than 10% in a calendar quarter in 2021 in comparison to that same calendar quarter in 2019. So for example, you had a business, you're using Q4, I'm just going to use that, and you had a $50,000 in 2019 was your gross receipts. It had to be less than $5,000 in that same quarter in 2021 in order for you to be severely financially distressed. So it's just, keep in mind, it's for really distressed businesses, right? And if they qualify for that and they meet that definition, no matter what size, so even if you have 600 employees, 1,000 employees, you can still use the wages, used for qualified wages up to $10,000 per employee, and you don't have to worry about whether they were, services were provided or not, because as most people know, the big employers are only eligible for the credit based on wages paid for employees that were not providing services. So what did they do here? They opened it up. They said, hey, you big employer, we get you, we're going to give you the credit whether the employees were working or not working, which is not typical under the normal ERC program. So that's, again, that begins in Q3 of 2021. So it's not available yet, but it's coming. Any questions on that or comments?
So
No,
I'm
I just
thinking of
wanna-
like that.
Go ahead, Suzanne.
Go ahead. Okay. I was just thinking, Norm, of the types of industries that may qualify for that type of thing, where they would let go of a bunch of employees and then pay them, you know, furlough their employees and pay them while they were on furlough. So that's kind of the businesses that this is targeting, right?
Yeah, I think it's going to be those really large businesses that had that exact situation. And I think the government's saying, hey, we want to acknowledge the fact that you paid those folks, and we're going to give you some credit for that. I think there must have been some lobbying going on there.
I was
sure.
going to say that. I was like, whoever this industry is has spent some time in Washington.
Exactly.
But, you know, lobby expenses are not a PPP expense, and they are capped. Also, I read this the other day when I was looking at the new IFR. If you are a not-for-profit, for example, and over, I think, 20% of your expenses are in lobbying, you're completely disallowed.
Yeah, you're out.
Yeah, it like shuts you out completely. So, fun fact.
Yeah, that's great.
No, Suzanne, Norm, Suzanne made my comment, but since she brought up IFR, I'll point out to our readers that there were some new IFRs published this month, including one that was just published on the 18th. So a lot of these changes that to the PPP loan program from ARPA, you can go to treasury.gov and look them up. And there's
otherwise we would have nothing to talk about. But they gave us an IFR that dropped it right before our date here, so we were pretty psyched about it. Gave us some good weekend fun, guys. All right, moving on, Norm.
All right. Yeah, so here is the, here we got the interplay with the ERC and the PPP, and there was a lot of questions regarding 2020, because they changed the rules as the game was being played, right? And so folks were saying, well, how is this going to work for me? I already, submitted my PPP loan forgiveness app, and so IRS finally issued some guidance. That was that notice 2021-20 that I was talking about earlier. And it really, don't be afraid, because it's actually pretty easy to read. So anybody can read that and understand it. Some great examples in there of that. And we're going to go through a couple of examples when it comes to, calculating the ERC eligible wages during that covered period when you have the interplay of the PPP loan going on and what you reported on that forgiveness app. So we're going to get to that in a minute. But we are, just keep in mind, this notice 2021-20, people are getting confused here. These are only authoritative guidance for the 2020 ERC calculations that we're performing. So when you're going back and amending your 2020 payroll tax returns, all of that, this guidance applies to that. 2021, we're still waiting. And they made that clear right in the notice. They said, this does not apply to 2021. We'll get back to you is what it says on what we want you to do there. But some of the questions are still, hey, are the PPP loan forgiveness proceeds included in gross receipts, in 2021? So that's a question that has come up. Our employer sizes, right now, that size is based on full-time employees. They keep using that phrase, but they're not saying it's full-time equivalents. Well, that can affect the calculation of whether or not we meet the requirements. And then, of course, then we have, what do we do about, the reduction of the expense? Because remember, when you take this ERC, you have to reduce the expenditures for wages, for example, for the amount of the ERC. So you've got some questions there. What year do we do that in? So those are some open questions still to come with this further guidance. Anything else? All right. Really love this chart, and I hope you like this too. It kind of, for those that like a visual, I like this because it lays out 2020. This is for 2020, and remember that officially the pandemic was issued, it started on the 13th, right? So as of the 13th, through the end of the year, you can see here in this example, they had a covered period, a PPP loan, and the covered period was from April 22nd to October 6th. Well, any wages in that period, right, are not going to be eligible because you used them for the PPP loan. So you're not going to be able to use that for your ERC tax credit. But the wages before that and the wages after that period, assuming you met the requirements, those are eligible wages. So this is a nice chart that kind of, you know, gives us a visual of how you should look at ERC. You're still applying to employee caps, you know, per employee and all that good stuff, but it's just a nice little visual.
And Norm, just as a reminder, when you know, if you're going back and revisiting whether or not you were eligible for your ERC credit, remember that there's kind of a break between 2020 and 21. So 2020, you're looking at $10,000 in wages for the entire year, and so it's quite possible for, you know, even if you got a PPP loan and used it, it's still quite possible that the bulk of your employees made more than, you know, $10,000 in the balance of the year in 2020.
Yeah, that's a good point. And I'll say this, we've been reviewing some of the ERC calculations for our clients, and you know, what you want to make sure here that you're doing, and I see this very commonly missed, is the 941 has a worksheet 1, and that worksheet 1 is critical in calculating that ERC refundable credit. And what's typically missed is that folks are not completing step 1 of the worksheet. They're dropping right down to, you know, step 3, and what happens there is they're overstating the ERC credit. So just thought I'd mention that. This would be, you know, as we move on to some examples here, but I wanted to say that's commonly missed. So just keep an eye out for that, and keep an eye out, quite frankly, for there are companies out there that are helping with the credit, and their credit is based on a percentage of the credit they help you obtain. So just keep in mind that that's what they're doing, and we're reviewing some of those as well to make sure the credit calculation is correct before we.
Fixed fee though, we're not doing a percentage.
Yeah, we don't do that. So that we're out to make sure it gets done right. That's the bottom line.
Although apparently not illegal, I question it, you know.
So, all right. So we'll move on to some examples in Notice 2021-20 and the interplay between PPP and the ERC. Now, just follow the facts here with me. They got a $200,000 PPP loan in this first example. This is right out of the notice. The covered period, Q3 and Q4 of 2020, there were qualifying wages of $250,000 that were paid. There were no other eligible expenses paid. You know, apparently there was no rent, no utilities, all that. They got the loan forgiven. Let's keep going down. The whole loan of $200,000 was forgiven. What was required to be reported on the forgiveness application? Well, they were required technically to only report $120,000, right? The minimum payroll cost, 60% of $200,000. They obviously had no other expenses, so what did they do? Here, what they actually reported on the loan forgiveness application now was the full $250,000. This happens a lot. We see this where folks just put more than what was required, you know, for payroll, for example. And so that's what they reported on the forgiveness application. And so how the formula works here is you take, and I've got this here on a slide for you, A minus B plus C. But here, you're not getting penalized in essence for over-reporting qualifying wages on the forgiveness application. Because here, they had $250,000 of wages. They reported that on the forgiveness application, make life easy, right? And they just put the whole $250,000. Well, you still are eligible for the ERC for that $50,000 that you over-reported. So you're not getting penalized for that. So keep that in mind. You know, I will say this. Go ahead, Andrew. Yeah.
Oh, yeah. I was just going to point out. I mean, this is super common. We see this with a lot of clients, and just keep in mind that even if you report more expenses than your loan, from the government standpoint, you can only use those expenses up to the amount of your loan because that's all you're getting forgiven for. So anything you report in excess goes back in the pot.
Yeah, that's a good point. So and this example makes sense if you think about it, right? So there was $250,000 of wages. The loan was $200,000. You know, they definitely had more qualifying wages than what necessary for the PPP loan forgiveness. So they got that extra $50,000 to use there. So that's pretty straightforward. But let's take a look at the next example. The next example is example 3 of the notice. And so here we got a $200,000 PPP loan. We have wages paid during the covered period here of $200,000. they have eligible expenses, other eligible expenses of $70,000 that were paid, rent, utilities, etc. They did get the full loan forgiven. Well, let's see what they did. What they were required to report was at least $120,000 minimum of payroll costs, right, on the forgiveness application. But what did they actually report? Well, here, which is very common in this example, they took the easy route, right? They said, well, we're not going to bother with all the expenses. I know we paid them, but I'm not going to go back and mess around with that. I'm just going to put the payroll, $200,000 of payroll. I paid $200,000 of payroll during the cover period. I'm just going to report that. My loan was $200,000. I'm good to go. Well, if you look here, none of those wages in that period are eligible for the ERC. And that really, that's really not a great outcome, right? We would have liked to have had a different outcome there. But, what I would say here is, why do I say that it's not a good outcome? Well, because the rules of the game changed after these folks, for example, would have filed the application. Had they known about this new rule, maybe they say only $130,000 of payroll costs on the actually reported loan forgiveness application. They actually do report the $70,000 of eligible expenses. They still get the loan forgiven, but what does that do? It creates an additional $70,000 of eligible ERC wages, because they paid $200,000 of wages. They had the hindsight here, and they would have had the ERC. They would have got the ERC on $70,000 of wages. So that's why this is still a problem. And there's two things that are people, are screaming on Capitol Hill right now, putting a lot of pressure on Capitol Hill, and that is this issue right here, okay, because it's not fair. If clients would have known, or businesses would have known, they would have reported only 130, let's say, in wages and 70,000 of expenses, and still had some opportunity for ERC. So they're complaining about this, putting a lot of pressure on, Congress, and they're also the whole idea with the Schedule Cs that we're going to talk about, how now they can use gross receipts to compute their maximum loan amount instead of net income, which is for those that did it already. That's what they did. So that's a really raw deal. Those are two raw deals that we expect there's going to be some changes, but we'll wait and see.
Norm's going up to Washington. He's pretty excited.
I'm excited. I'm going to go up there myself. Exactly.
That's what I said. You're on the way.
We're running a little bit ahead. We've got a couple questions about ERC. You want to let's just tackle those real quick while we're here.
Yeah, sure. That'd be great.
So the first one, if I'm understanding this first one correctly, I think what the writer is asking is do you have to requalify, and if you did or did not qualify, either one, for the credit in 2020, do you requalify in 2021? So in other words, is it a separate test in both years?
It is a separate test. So you've got because the tests are different in both years. In 1 year, the qualifying test is the 50% of gross receipts decline, and in 2021, it's a different test. It has different calculation, of course. So you just want to make sure you're documenting your eligibility and that you met the requirement, because nowhere on the 941s is that information. This is what's interesting here. Nowhere on the Form 941s, the payroll tax returns, is this information about eligibility actually reported. If you think about it. So you want to talk about where there's going to be the next round of, frivolous activity. Yeah, and you wonder how much, are they going to really audit all these payroll tax returns? I have a feeling that the IRS is going to change their approach, and they're going to audit more payroll tax returns than they are in income tax returns. So that remains to be seen. But that is a good question, and again, that's something you got to document and keep in your files. Be ready to prove that.
And I would say, wouldn't you agree, Norm, if you qualified for the 2020, you most likely qualify for the 2021.
Exactly, but you still want to show that calculation. You just go through the process.
Absolutely. So the second question we got was, if an entity existed prior to 2/15/2020, but didn't actually start operating until after 2/15/2020, are they considered a startup, and which quarters can they qualify for the ERC? Do we have guidance on that issue yet?
I would say we don't have official guidance on that. I would say that the language we've seen used is that it started operating after February 15th. So, this happens a lot. Entities will be formed in contemplation of a new business starting, right? So I can see, for example, the question here of, hey, maybe I formed my entity in January, or maybe I formed it in December of the previous year, and then I started after 2/15. Do I qualify for that enhanced piece? I would say that we don't have enough guidance for me to sit here and tell you for sure that that's the way it's going to roll, but I'm sure we're going to get more guidance on that.
Excellent. All right, Suzanne, I think it goes over to you.
All righty. So real briefly on this slide, just to note that the new act did add an additional 7.25 billion in funding, and the original, or the, I guess, PPP Round 2 changed the date of application to March 31st. And so that is still right now scheduled to close as of March 31st, even with the additional funding. However, all these people in Washington that are arguing norms issues are also up here talking about this. So it has passed the House, and it's currently in the Senate to expand that deadline for PPP Round 1 and 2 until May 31st. So we'll, of course, keep you posted on any information there, but the intention, obviously, with adding more funding is to extend the time period to allow more businesses, and with the expansion of restaurants and the 501(c)s that Andrew talked about earlier, to give them an opportunity to get in on this. So we expect to see that extension coming through pretty soon.
Yeah, and Suzanne, if I could just add, part of the reason why they screened for this extension to May 31st is that the SBA has been changing its systems and how they're scrutinizing these applications. And if anybody's noticed, it's taking a lot longer to go through the systems. They'll sometimes bounce back, and then you're submitting again, and then it keeps getting a little bit of ping pong action in between. So they just said, look, your systems are changing, you're taking too long to process these applications. We need more time. It's not fair for some of these businesses that can't get these loans through. So that's a lot of what's driving this too.
Yep. So this slide, we're just going to reiterate some of the previous items. How can you get another first draw PPP? So this is draw 1. Borrowers who return their loan or part of their loan. So they originally got it, and there was all this talk of, well, if you don't have a need, you better return it. And a lot of people got a little nervous, and so returned either part or all, and then decided later, man, I really did need it, I should have gotten it. So they can reapply for round 1 if you did return part or all of your loan. If you, again, did not accept the full amount that you were approved, you said, let me just take half. So, one option is you returned it. The other option is you just didn't take it. And then the last bullet here, bullet 4, we've been getting a lot of questions on is, well, what if I applied for forgiveness and only received partial forgiveness? For whatever reason, they don't know why they didn't get fully forgiven, but they were maybe not forgiven for the full amount. Can they still apply? And so the answer is yes. And so you still have to certify that you used your PPP funds for eligible expenses, and you have to meet the 60% payroll test. And so if those two, if you can say, yes, I spent it on eligible expenses, and yes, I spent 60% of it on payroll, even if you were not fully forgiven, you are still allowed to apply and get round 2. All right, so just again, repeating a little bit of information here on second draw. What do you have to do to be able to qualify for second draw PPP? You have to have used or will use your full amount of round 1. So again, we've talked about timing in the past, and that will change a little bit now if they are going to be extending it to May 31st, because there was a kind of a small window initially when round 2 came out to get both rounds. So if you had not gotten either round, there was a pretty short window to do both. If they do extend it out to May 31st, it's possible that if you haven't gotten any rounds, and you're late and you missed our webinars 1 through 9 and you're just coming in here for 10, you do have time now, it looks like, if they extend that to get 1 and 2, as long as you use all the money from round 1 or will use all the money from round 1. Second draw, they decreased the number of employees to 300. And there is one additional piece that's probably the most important one, is that you had to have had a reduction in gross receipts between comparable quarters in 19 and 20. So you've heard us talk a lot today about comparing quarters. So if you have not already internally looked at your books and done a quarter by quarter analysis of your financial statements, I highly recommend it, because everything that we've talked about today and everything that you may be asked to do in the future to prove anything or sort anything out with any of these governing bodies is going to involve a quarterly analysis of your financials. So just a point here, if you haven't run that exercise internally yet, I would go ahead and put your books together on a quarter by quarter report basis and get that information ready.
So Suzanne,
yep.
maybe two real quick points here. One is that, also keep in mind when it gets confusing, right? Because we've talked about 3 different percentages now, that you're measuring 3 different declines, 50% and 20% for ERCs, 25% for a second draw PPP. Also keep in mind that if you had a 25% or more reduction for the year in 2020 compared to the entire year in 2019, you're also considered to have met the revenue reduction standard. So
for PPP Round 2, but not ERC.
That's right, for PPP Round 2, but not ERC.
So it's definitely, again, get your quarter by quarter financials together, get your percentage of decline. If you had a decline, know that number. And then once you know that number, you can figure out which of these slides will be applicable to you. One also comment here on the accounting method that you need to use. And so we understand it right now that it can be accrual basis that you use for your GAAP financials, and it can be your tax basis. So if you file your taxes on a cash basis, you can use that method of accounting, or financial, GAAP method of accounting, which is accrual. So you do have those 2 options. So you may want to run those financial statements on both if you are using one for tax and one for GAAP purposes. So we've been getting a lot of questions about this. So clarifying the good faith certification, if that name or term sounds familiar to you. When everyone initially filed for PPP, you were required to certify that economic uncertainty made this loan necessary to support operations. And so what's changed here is that loans less than 2 million and Schedule C borrowers with 150 or less are already have deemed to have made that good faith certification. So if you are less than 2 million or less than 150 on a Schedule C, they deem your business to be smaller, to have not as much access to capital or access to available funds. That the pandemic may have hit you a little bit harder, and so you are already deemed to have met this good faith certification. So loans greater than 2 million and Schedule Cs with greater than 150 will have this, review from SBA of their loan to make sure that it does meet the qualifications for economic necessity. So if you do have a loan greater than 2 million or greater than 150 for a Schedule C, expect to get a letter for a review of your loan. It will happen at some point. We are starting to see a lot of these come through with our clients and a lot of questions about this. So again, some of our previous webinars, we've talked about what to have ready. You need to have all of your documentation ready from when you filed, have all of your payroll reports, have all of your supporting documentation, have everything ready that you can submit to the SBA to prove out your numbers on that loan. Right now, we have not had a lot of clients that have had to repay. If you are found to be not in compliance, you would have to repay that amount that they're saying. I can only speak for our client base here. I'm sure on a global or national scale, I'm sure there's many people that have had to repay a portion of their loans, but we have not seen a lot of it internally. And we have had some loans below 2 million that have been chosen for review. So don't forget that it's all over 2 will be, but anything under 2 is the roulette wheel. You know, you may get picked as one of the loans that will be reviewed. So we do have some clients less than $2 million that have been chosen for review. And so just get your documents ready. It's nothing to be worried about. It's a process. It's not anything that you potentially did when you filed. It's just part of the process. So just know that may be coming. Anything to add there?
No, I think those are all great points. I know you're about to touch on some more on the next slide here.
Yeah, just a little bit here. So we have been getting a lot of PDFs coming over in email. Hey, I got this letter. I don't know what this is. Can you help me figure it out? It's asking me all these questions, and people are getting anxious, thinking that this is just them and they're being singled out. It's not. This is a multi-step process that the SBA is going through to just ensure that everyone, did the process the way they were supposed to do, and make sure that again, the process had integrity throughout, each step of it. So this is the loan necessity questionnaire. So it's pretty lengthy. It's a couple pages long. It's a lot of questions. It doesn't mean your loan is being challenged. It doesn't mean that there's any question to your integrity when you filled it out or your certifications that you made. It is a question and answer. They're getting data, they're getting information. It's just part of the process. So if you have gotten one of these questionnaires, don't worry, you have a very short timeline to fill it out though. So look alive. If you have gotten it, make sure, I think it's 10 days, but it's very fast. So you want to make sure you're on top of it, and you either get it, with your bank or your CPA, and make sure that you're answering those questions appropriately. So then you don't get a second round of letters and questions. So if they come back with additional information, you then have the opportunity to write a memo explaining your position. I have not had any clients that have gotten that far. They've just filled out the questionnaire and it's a done deal, and then they get a forgiveness letter not too long afterwards. However, we did read that you have an opportunity to write a memo if in fact they question any of your responses from the original submission of the necessity questionnaire. So Andrew, you may have had something to add here.
Yeah, Suzanne, I'll just point out that, for those who are really curious, this is SBA Form 3509. You can find it on the SBA's website. And the questions are generally centered around 2 aspects. One is access to liquidity or access to capital, and the other is business activity. Was your business shut down, or how are you impacted by the pandemic? And once again, this is part of one of the tools the SBA is using to review these loans, particularly the loans over $2 million. If you get this, like Suzanne said, don't panic. You just got to fill it out, get it in, and address it as it comes. So.
Yeah, and I'll just add, if you haven't done, a process of documenting, your necessity, you should do that now, because you're going to forget. We're all going to forget what we did a year ago or 2 years ago. So now's the time to do it while it may be still fresh. Take copies of articles. Things that you saw that might have affected, the situation, conversations you had with suppliers. All kinds of different things. Document all that now. Take the time, because you're not going to remember later on. So.
Or you'll have some other dumpster fire happening that week, and you'll be like, man, I had it already. Look at me. I'm all over on top of this game right now. So you guys know those weeks happen. So just prepare for them. That's what I always say. You can't avoid them, but you can prepare for them. All right, some more notable issues that we have noted are the extension of the tax deadline, which you probably all have seen already, extended to May 17th. Us CPAs were pretty excited. I mean that sarcastically. So for all of you procrastinators, Anyway, so just a word of caution here. This does not include corporate returns or trust returns, or this is important here, estimated tax payments. So if you owed money with your, or if you owe money with your 2020 return, that has been extended to May 17th. But your first quarter estimated payment, if you're a person that pays quarterly, that payment is typically due on 4/15. That has not been extended as of yet. We don't really have any information on whether it will or will not be at this point. There's discussion, but that's about as far as it goes. So when your CPA or us, we're reaching out to you, telling you you need to stroke a check, it is for 2021 first quarter. So understand that there's a difference there and that those payments have not been extended. Other thing to note here, that the state tax treatment of the deductibility of expenses for PPP money has not in all states mirrored the federal treatment. And so if you are playing in multiple states, you may have one state that says, yep, we are treating those as deductible expenses, and you may have another state that says, we are not treating them as deductible expenses. And so you may have a discussion again with your CPA about the different treatment of states that you're playing in, and they may be different. So just know that that is there. The EIDL advance, if you received one, that was the $10,000. It was a grant, essentially, grant money. You just had to go online and file for it, and they sent you money. It was based on your number of employees. So if you received less than $10,000, I think it was $1,000 per employee. So say you had 5 employees, you would have gotten a check for $5,000. Now they're saying, hey, we're going to give everybody $10,000. No matter if you had 5 or 12, you get $10,000. So if you were one of the people that got 5, we're reading that you don't have to reapply. They have a list of who got the money. And they have a list of, you have 5 employees equals, 1 times 1,000 is 5,000. They will go ahead and send you the remaining $5,000. Now, as we joked about earlier, we question the validity of their records perhaps. And so maybe, don't stand by the mailbox, but that is our understanding, is that you will receive the remaining money to get you up to $10,000, in the future. One of the other things we mentioned today that Norm is also excited about and will be lobbying in Washington apparently is the Schedule C filers may now use gross income. Now that's a big change because if you're familiar with the Schedule C, the net amount from your Schedule C rolls into your page 1 of your 1040. So if you have gross income of $100,000 and then you have expenses of $80,000 and you're really netting about 20, then your PPP loan was limited to that $20,000 of income that was coming to your 1040 page 1. Now they're saying you could use the $100,000. Well, that's a considerable difference for many people that filed that loan. And so if you are one of those people that are just now tuning into Series 10 here and you're just now getting a loan, you have the opportunity to fix that and get your loan based on that gross amount. If you have not gotten your loan dispersed yet, you still have the opportunity. Even if you've applied but not been dispersed, you can get with your bank and get that fixed very quickly. If you've already filed and gotten your money, we aren't sure yet what's going to happen. So we're hoping that they will allow you to get another round or something to correct this, because this was again one of those things, like if you had known and if this law was in place, you would have obviously used your gross amount. So that's another key point if you're a Schedule C, to look out for future information on that. And I know we're running really tight on time here. This was our last slide. So Jamie, if you're gonna pop back on and close this out, I think we are good.
Yes, and we do have some questions that came through. I know Andrew addressed a few of the ones that came through earlier on. We did get a handful more. So for those of you that have shared your questions with us, thank you. We will get back to you via email separately. So nothing to worry about there. we do want to thank you all for hanging with us. We had a good group on the line here and hope that you've taken something from today's information. I'm sure you have, but if you will take a moment on your way out, let us know in that survey again if there's anything that we didn't cover that you would like to know from our team. We're happy to bring that to you in a future session. So with that, we'll close out by just reiterating some of the ways that we're here to help you guys through this process. Our webinars, of course, have been a great way to disseminate some of this information to you all as we receive it. But know that our team is standing by and they're happy to help address specific questions that you have around your forgiveness and this process in general. So I think the three that we have here have really highlighted perfectly the level of expertise that we have on our team around this topic. And they're just a few of the others that we've got involved in this process. So thanks to you guys, of course, for staying on top of this and bringing the latest to us as always. Thanks to you all for joining us and tuning in. We'll hope to see you again at our next webinar, and we'll be in touch to share more details on that coming up soon. I hope you have a great rest of your day, and we'll send you off from here. So thanks again. Thanks, guys.
Thanks, guys.
Bye, guys.
Hi, everybody.